Hi, this is Brian Zeke, founder of Surf City Financial Group. I'm here today to talk to you a little bit about annuities. You will find a pretty good download in our Surf City Financial Accelerator, kind of walking you through each different type of annuity because there are a lot of different options, and within each type of annuity, there's also different options. So there's a lot to go over, and you're not going to find everything in that. Everything you possibly know about every annuity in there, but you'll at least have some good basics. That's what I'm going to try to give you today. Now, there's single premium, multi-premium, immediate, deferred, fixed, variable, and also within that fixed world, there's also a fixed indexed annuity, which is an offshoot of a fixed annuity, which is gotten very popular for some very good reasons, and we'll walk through that a little bit as well. Now, this first annuity we're going to talk about is actually a kind of your typical well-known annuity. This is how everybody sort of thinks of annuities: is you give the insurance companies some money and they start sending you checks, and that's one thing you want to remember about annuities. They are basically an insurance policy, an agreement with an insurance company to pay you out based on contractual terms. Now, this one is you'll see in here with the different payment options. Again, this is a SPIA, known in the industry, or single premium immediate annuity. And you're seeing three different payment options, which are very basic kind of payment options you'll find out there. There are offshoots of this as well, but what you're going to find is, number one, you see the payment option says period certain plus life. Now, what that means is, with the period certain plus life, is, let's say you're 55 years old, you bought this annuity, period certain for life, and a period certain is 10 years. So what they're saying in here, they're going to pay you at least 10 years. If you were to die in year 2, they're going to continue paying your heirs until that 10 years is up. Now, conversely, if you happen to live another 30 years, you're going to continue to receive that income for 30 years. And you're seeing, in this case, you're seeing $200,000 single premium, a monthly payment of $1,246. The non-taxable portion is $1,100, and the taxable portion is $134. Now, and you're seeing at the end there, it's an exclusion ratio of 89.2%. So what that means is the taxable amount is the gain. That's what you've earned in interest in this SPIA. Now, the second option is, and that's all you'll pay tax on. The second option is period certain. Now, that's period certain only. So what that means is $200,000 in, monthly income of $1,792, non-taxable, taxable, exclusion ratio. So what that means is, whatever age you took this at, it might be for 10 years, and that's basically what you're going to get paid for, 10 years. And again, if you die in year 2, your family's going to get it for 10 years. But if you live to 30 years, you're still only going to get it for 10 years. Now, you also have the life-only option. Now, depending on age, this tends to pay out the least, for the simple reason it's going to pay you no matter how long you live. Now, being life-only, this is going to change depending on your age. If you're 80 years old, it's going to be a different payout than if you're 50 years old or 60 years old. And it also means, if saying life only, if you die in year 2, that's it. It's done. And so that becomes an important issue. So it's always a good idea to, if you're working with us, we will, if we find one of these will be applicable to your situation, then we will work out what we think is the best deal for you based on age and needs and all that. So that's your SPIA, single premium immediate annuity. Now, this next one is a single premium deferred annuity. Now it's pretty basic. This one's fairly simple. It's kind of like a CD that gives you tax deferral. And I might add, it actually pays you better than your typical CD. So what this says is it's going to give you a declared interest rate for a guaranteed amount of time. Now you're seeing in this one, the guaranteed is 3.5% first year rate, 2.5% second year rate, and 1.65 thereafter. Now that's guaranteed in the contract. That's the minimums you'll receive. Now, depending on when you might purchase this annuity, if interest rates are up, you'll see these rates go up. So in this case, and this is a fairly new quote, you're seeing that what they're declaring is a 3.50 first year, 2.50, and 2.50 thereafter. So meaning this should pay you out 2.5% after the first year going forward. The big advantage of this is it's safe, incredibly safe. You get the tax deferral, and you can do withdrawals from it. You can do whatever you need to do it. Or if you just want to grow money for a little while safely in a safe place where you don't have to worry about it, this is also a great option. Very simple, very clean. So as you're seeing here, 100,000 in, and obviously you're seeing the growth. Here's your surrender value. Here's your annuity purchase value. So there is a surrender period on these. So you see on this one, the surrender period is basically 5 years. So meaning you'll see in that the surrender charges have gone off after 5 years, but you still get your rate and you still get your growth. So that's pretty simple annuity. They're very easy to understand and very easy to deal with. And that is a pretty short surrender period. Now, we're going to get into lifetime annuities, income annuities, and things like that, and different variations of those. Now, the SPIA is basically an income annuity as well. That's all it does. But we're going to talk about annuities that actually offer liquidity and will also offer you income for life. Now, we say shake the ladder here because when in a basic portfolio, and your average portfolio, average means nothing. Sequence of returns becomes a big deal. So in other words, if you are actually withdrawing money and the market takes a dip, your portfolio is going to take a pretty big hit, and that becomes a bit of an issue if you're trying to make your money last to mortality. But let's talk about that a little bit. Now, this first one is a deferred income annuity. Now, these are pretty simple, and these will change a little bit depending on the interest rates, your age, things like this as well. But if you take a look at this in this model, what we did is again, this is a pretty new quote. So we did a purchase date of 9/24/2018, and we're starting the income basically 10 years later. And we're going to be paying out monthly, and let's say we put $100,000 into this. So all this means is you're going to get a monthly income of $1,022, basically for life. Now they do have a period certain of 10 years on this one as well, just like the SPIA. But again, same thing. If you live 30 years, you're going to get this income for 30 years. A pretty basic, simple annuity. There's a lot of great features. It's very, very predictable. We absolutely know how much you're going to get in any given and guaranteed for how long. And the beauty of it is you can't outlive it. It's going to pay you forever. Now, this is a fixed index annuity. Now, I did put this inside the income options because you can do withdrawals on this, but this one is not necessarily designed for income. This is more designed to growth. Now, I've had people put in this type of annuity and then roll it over later on as they get a little bit older into more of an income type vehicle. And you're seeing your different options here. Now this particular annuity, all annuities have different indexing options. And you're seeing here your different strategies, S&P, gold shares, annual, iShares, so all these, plus you have a declared rate. In other words, a declared interest rate. In other words, what you can get guaranteed. And you can actually invest your money in any one of these. And you're noticing cap, monthly cap, participation rate, and all this. So what this means is, in this first category, you can't lose money in this, but the most you're going to gain is 6.15%, which is not bad. That's your cap. The good news is if the markets happen to go down, the worst you can do is zero, because sometimes zero is our hero. And you're seeing annual monthly sum with monthly cap. Now this is an interesting one, is you can actually make 2.40 per month. The bad side is if you happen to get one bad month, it could wipe out any gains. Again, worst case scenario is zero. But if you multiply this out times 12, you can actually make a lot of money in this particular one. I've had people do really well in these. Then you have these, then you have a cap one again. Now this is a participation rate. This one's uncapped, but they give you basically 65% of whatever you have invested. So if you've put your whole $100,000 in here, basically you have $65,000 at work for you. So now you can do really well. If it really goes up quite a bit, you're still going to do pretty well. But that does kind of put a bit of a collar on it. Again, no downside risk on any of these. And this one has a 750 cap, kind of very similar to the S&P is on top. This is again another participation rate, meaning it's 70%. And then again, that declared interest rate, that's a fixed rate you're going to get on this. And this is a pretty good little growth vehicle that's incredibly safe. I mean, the worst you can do is zero. And here you see some historical returns. This is basically the most recent 10 years. It is rolled over a few times. So you're seeing your different rates of return here that you would have earned. So on any given category, for instance, there's a risk control one. You're seeing that the years the S&P didn't do well, you got a zero, and then you got some upside. So again, and so you're seeing your account value here growing. Again, no downside risk, just upside potential. You're seeing this one here. Remember we said about the cap. You're seeing here that it capped out quite a bit. So this is again pretty straightforward. No, there's no riders on this or anything. It's just a pure growth vehicle. But again, we do have people that will use this for growth and then drop it into something that's rolled over after a period of time that you can actually put into the develop income. And some people just use this because they want the safe growth, but they still want enjoy some of the market upsides without the downside risk. Now this is an indexed annuity with a guaranteed income rider. Again, this has a 10-year look back as well. Now you're seeing in this case, and this was actually a real case I did a while back, and this one in this case we put $186,000 into it. Now this is actually a fairly simple annuity in that, and by the way, this annuity does pay out for life and we can have this pay out for 2. And what this one was doing is actually guaranteeing 2 lives, husband and wife. And you're seeing again index returns, and this is a 10-year look back. This is what this annuity would have done over those last 10 years. And you're seeing the accumulation value here. And you're seeing this is a 7-year surrender period. So you're seeing in that it actually, they become the same thing. Now the other thing you're noticing here is this beginning withdrawal percentage. Now what I like about this particular annuity is as you defer, your payout factor goes up about 40 basis points every year. So I've seen this get up to 8% if we've been able to defer long enough. So that's a pretty good payout. Now, and you're noticing here in year 6 when we're starting this annuity, you're going to get an income the first year of $13,000 based off of your accumulation value here. So basically you're getting 6% of $217,000. Now, the other thing I really like about this annuity, what's very helpful as far as fighting inflation, is anytime you get a positive income index return, you're seeing that your income goes up along with your account value. Now, obviously, the account value is being driven down just because we're continually withdrawing money. But what you're seeing here is that like for instance here, we got a 5.26 return. So your income went from $13,000 to $14,000. Simple as that. And that'll go on forever. And you'll notice here at age 90, we're completely out of money, but that same feature still continues to go on. Because you see here at age 100, you would have received almost $37,000 where you started out at 75 at $13,000. And you see you would have put 186 and taken 586. This is a very very powerful annuity. This one's been really handy to have in the planning strategies. Now, this actually is that same annuity, that same style annuity, and we're actually seeing the income rider, 10-year look back, everything else. But what we're doing here is we're actually showing it against other types of returns. Because what you have here is 186 going in, right? You get your index return. Now, what we did here, this is the index return. This is your income receiving it. So what we did, we made these other accounts match it. So here you have a market-based account with a 6% steady return. Well, we know that's not going to happen, but for actually showing how this works, we thought this would be a pretty handy thing to illustrate this, because you're seeing here again the same income out of both annuities, but what you're seeing is here, even with that steady 6% return, we completely ran out at age 93 with this, and so the money basically stops as soon as your cash values. And again, the annuity, that you might run out of cash values, but your income keeps going. Now this is basically the S&P 500 over the last 10 years. Same thing. We made it match the annuity as far as income. And what you're seeing here, because of sequence of returns, you are seeing that some years it took a bigger hit than others. And the other bad thing is, in this case, you see that once you're out of money, you're also out of income. And again, the annuity doesn't suffer from that. And then finally, we did 6% on average, but we changed the returns around, and made them do different, get different returns. So we averaged 6%. And you're seeing that was kind of our worst outcome. Again, matched the annuity and ran out at age 85. And you're seeing ultimately this person from 76 basic to 95, you're seeing they would have received $412,000 with the annuity, $378 with the 6% steady return, $224 with the S&P 500, and $160 with the problem with the sequence of returns issue. So that can be pretty powerful. And that's the guarantee of the insurance company to continue to pay you. Now, this is another one. This one is basically has a 10-year deferral period. This is a bonus annuity that also has an income account. And this is a little more typical of income annuities, where they'll have a guaranteed roll-up, and which is the more normal, like with variable annuities. This one doesn't have a guaranteed roll-up, but what it does do, what you're noticing here, in this case, you got a 6.43 return, on the actual credit and interest rate, but for the income account, they gave you a 50% bonus. So your 6.43 turned to 9.65. The other thing you're going to see is interesting is this annuity has a pretty big bonus going in. So you're seeing $250,000 dropped into this annuity. And with the return in year one, we had $334,000 of protected income account. Now, protected income account, in a sense, is not real money. And that's where a lot of people get confused with these types of things, especially with variable annuities. I see it all the time. And now, in a sense, this is real money because if you were to pass away, you can actually use this as a death benefit. That is an option you have with this particular annuity. So what you're looking at here, 250 in, you got the bonus. So you're starting out at 334 after you got credit with 9.65. And you're seeing this growth going along. So now you're down here, and now you're getting about a 5%, 5.5% payout off of this. So you're seeing you're getting $29,875. Now this annuity happens to have a very similar feature to the other annuity, because you're noticing here $29,875 to $32,749. So meaning you got this 9% return, so your income went up 29 to 32, and so on and so forth. And the same thing's going to apply. You're not going to see the same comparison here as it did in the other one, but I think you get the idea. So in this case, this person is 64, and they could probably expect to get somewhere around $1.1 million out of this annuity over that 30-year period of time. And even though we start income in the 10th year, or actually the 11th year, because this one has a 10-year deferral period. So this is, I have to say, one of my favorite annuities. Now, variable annuities, and this becomes pretty important because what you want to know about variable annuities, and basically this one had a $250,000 balance here at age 64. And you're seeing this basically, this is an S&P return, but this is variable annuities are subject to market risk. And now, the one thing that they'll tell you about variable annuities is if your account goes up higher, because you get a guaranteed payout amount, and in this case, it started out 14. Well, the annuity off in year one got some great growth, got 16%. And I have to say, I don't see this a lot in these products because of the drawdown. The account usually doesn't go up past, but we in this case, just timing is everything. So from 14 to 9 to 16. Now, the other thing you'll notice is you took a big hit here. Now, because this is guaranteed, you're going to continue to get this money. So you're seeing 251 in, you end up getting 432. Now, this is your guaranteed account. Now, this paid 5% guaranteed roll-up every year until you turned on the income. In this case, when we turned on the income, and you're seeing the steady growth here. Now, this is not real money in a sense because this is basing your income, right? This number right here. But your real number is all the way over here, because this particular annuity does have a guaranteed 5% roll-up amount and about a 5% payout. So what you're seeing here, the number we got to is 270, and you got 14,000, and that's basically what how it continued to pay forever. So in this case, we got a little lucky. And we got that big growth year, and so the thing to remember about variable annuities is the cash value is absolutely subject to market risk. The other thing you'll know is they tend to be more expensive than fixed or indexed annuities. They have fund fees in them, and if you have a rider like this, there's usually a rider charge. So be aware of those things, and that's one thing we do is we analyze these things and make sure we get you one that fits into your plan. So by going through our Surfacing Financial Accelerator, you'll find out if annuity is right for you and which one would fit you.